Welcome, Theo Traders. This is Brandon Chapman for the Wednesday video and for Don today. I'll be back on next Monday as well. But want to get started today with three impact trades to kick off 2024. Why not? We've got the first two trading sessions of the year, both down days thus far. We're about to close in about an hour. We'll see, do we sink into the abyss? Do we rally? Do we stay the same? But the bigger play here is, what's going to happen as we progress from January, February to March as we get ever closer to the next Fed meeting in March, which is kind of a pivotal one in terms of, does the Fed raise rates? Do they lower rates? Do they stay the same? Of course, odds are right now they're looking at a first rate decrease for the March meeting. All right, so let's talk about the market here, because anytime you experience selling for the first time and really for a long time, 4 consecutive down days here. When was the last time you've had 4 consecutive down days? We would have to go back quite a long period of time. Let me make sure I got on candle trend. Sorry, 3 consecutive down days. 3 consecutive down days, the last time we had that was on 12/4, but for all intents and purposes, it was sideways price action. We would really have to go back to late October, the last time we saw 3 consecutive down days in the S&P 500 of any worth or any magnitude. And so when you start to see this, panic may set in. The sky's falling, right? Or maybe opportunity starts to pop up. Maybe you start to see going back to those same old plays that worked before. The reality is, what we've seen over the last couple of days here, the first 2 trading sessions of the year, has been what? If we look at 1 week performance, you'll notice energy, healthcare, utilities, consumer staples, even financials. Stocks like Citigroup are up today, right? The last couple of trading sessions. But what you're seeing is very defensive oriented rotation. And why would energy be defensive here? Well, predominantly because there are geopolitical concerns that may affect oil prices. And frankly, oil prices have come down quite a bit. And so we try to think about, what are the 3 areas or 3 impact trading ideas to kick off the new year, 2024. We have to take into account, to some degree, the rotation that's happened in the first 2 trading sessions. Now, the backdrop of the S&P. Is the S&P poised to go higher? I have a few indicators I generally look at to give us an example of when the market's positioned for a rally and when it's positioned for correction. One of those things is the VIX. If we look at the selling of the last 2 days, it has not really engendered any sort of movement in the VIX. The high today is maybe about 14.2. Again, we're kind of fading from our highs a little bit. The VIX is not moving right now. Well, why? Why is the VIX not responding? Why is there not more so-called fear in the market? The reality is the market's already hedged. If we look at the skew index, for example, the skew index has maintained above 130 now since when? Since April. We've had a couple of little days where we were just barely below it. For all intents and purposes, we've been above it. And recently, as recent as December 14th, the skew index was 162. If the skew index is rising, and especially when it's above 130, what does that mean? It's an indication that the market is hedged or hedging, right? The idea is that the line rises, it means that there's hedging activity going on. The fact of the matter is, for most of this year, on the institutional side of things, there's been a lot of hedging that's already been done. And in fact, again, we look recently with the VIX, we saw a little bit of movement to the upside in September on the VIX to about 22 handle. Well, we count forward 1, 2, 3 months. As we get towards the end of January, a lot of the protection was bought back here in October is going to start to roll off the books. But we do know askew, hedging, or the degree of hedging that's in place right now, is relatively high. If we look at how the back month volatility, let's take 3-month volatility relative to 1 month. This was recently, for about a month, above, since November 22nd, above 1.2. What this means is the 3-month VIX is 20% higher than the VIX. This is a critical threshold. It suggests that the market is expecting volatility in the near future. And when you get high skew and high back month volatility, this is a recipe, generally speaking, for a 5 to 10% correction in the market. And so right now, we're still in that mode of looking for that 5 to 10% pullback from the high. So going back to the S&P 500, despite the fact that the market has had a few down days, what we've seen is that for all intents and purposes, we're kind of rotating away from higher risk sectors, like, for example, technology, and we're rotating towards lower risk sectors like utilities. We're not seeing money being pulled out of the market en masse. And that's why you're seeing the S&P right now just see a couple of down days that are less than one ATR or one average true range, which today it was about $3.88. $3.88. Well, right now we're seeing a down day of about $3.16. We're not even having a significant down day. Why? Well, again, this goes back to the fact that, look, there's hedges that are already in place. The market, generally speaking, is delta comfortable. I remember hearing this in person from Tom Preston, who designed the Analyze tab on thinkorswim. I was in the Chicago thinkorswim office, and I was talking about the Analyze tab, all excited about it. He kind of rained on my parade a little bit at the time. This was 2006. And he talked about delta comfortable. The fact of the matter is, for the most part, institutions are comfortable, meaning what? It means that they're comfortable with the market decline. They're comfortable with the market rally from here. The fact of the matter is, we're seeing just rotation to defensive sectors. We're not seeing real money being pulled out of the market en masse, which would create a much more of an acceleration to the downside. What that means is we've yet to reach a point where we have seen real capitulation. Capitulation. And that is what we're looking for. So the big bottom in the market, generally speaking, occurs when? Well, let's go back to our 3-month to 1-month VIX. And if this gets down here below 1, meaning what? The 3-month VIX is less than the 30-day VIX. If we're down here, that's an indication we may be nearing a bottom. The market's expecting lower volatility in the future. If we see the skew come down, meaning that the hedges that are being put on are long puts, causing the VIX to rise and causing skew to fall. A skew down here about 115 to 120. This is a kind of a market clearing area where there's a low degree of hedging, and the idea is we're cracking open the upside in the market. Seeing what? Seeing backwardation. If we go to product depth here, this is the VX. So right now we're seeing prices are rising as we move in the future. If the VX goes into backwardation, that would be an example, right, of expecting lower volatility in the future. We're not there yet. So what it suggests is that the market right now is not really close to a near-term major, or really kind of a near-term, more of a significant bottom. Is it possible we could rally and retest our high? Sure. The fact is, the road from here to the upside is what? It's going to be relatively arduous, right? It's going to be slow. We might see grinding day after day if for some reason we flip around and this list gets reversed. But the fact of the matter is, after a major, 17% rally off the lows, we're very much poised to see more drift to the downside. Waiting for that day of capitulation where you start to see a bigger down day and a much higher level on the VIX. If we look at the VX futures here, notice that we're looking at the current active contract for February is about 15.5. The next contract's about 16.5. If we just take a straight average, that's about what? It's going to be about just under 16 to 15.9 or somewhere around that area. Now think about it this way, right? The VIX, the spot VIX, the 30-day VIX here, this is going to have to be north of 16. And if the market were to sell off, the VIX futures curve is going to shift higher, which means we're probably looking at an 18 or 20 handle in the VIX before we find any sort of significant bottom in the S&P 500. That's what we're waiting for, right? We're looking at these indicators to help identify that point, but just remember, any sort of real significant bottom where the market has a chance to really rally off of it, we're going to have to see better dynamics, much higher VIX levels, and what? We're going to start to see the front month VIX, the 30-day VIX, start to creep above the back month VIX, we're going to see skew come down. And that might need us to get to about 45.50, maybe even lower. And in fact, if we draw a fib retracement from high to low here, from low to high rather, you'll see a 1/3 retracement, 45.29. 2/3 retracement, 43.66. We're probably going to need to see some sort of movement down into this area, and it may not happen all at once. It might do this, right? But it's going to take some degree of downside movement right now for us to kind of reset before we're going to see any sort of major bottom. And so the point is, as we look forward and we say, okay, 3 trades to start the year, we have to start from this premise that the downside risks to the broader market are intact. The second thing we have to understand is that if we're looking at treasuries, now treasuries are kind of backing off our high here. The fact of the matter is that the Fed funds rate at 5.25% to 5.5%, what is the neutral rate for the 10-year until the Fed actually begins to start cutting? I've said this going back to this point here. The neutral rate, if growth starts to flag and we start to see the Fed on hold and maybe even looking to cut rates in the near future, is 4 to 4.25% down here. This is the downside potential. We stretched below that because it looked like the Fed was prepared to cut in March. We'll see what's going to happen there. But the fact of the matter is, everyone right now is long. We went from being short to now this being the easy trade, being long treasuries as the Fed begins to cut rates aggressively, maybe as much as 1.25% or higher in 2024. This is a really sticky point because if we start to do something on borrowing costs, on rates, guess what's going to happen to the dollar? What may happen to inflation? What may happen to oil and gold, right? As kind of the anti-dollar play. And this one here, certainly factoring in geopolitical risk in terms of oil supply. We got a lot of stuff, conflicts happening right now in the Middle East. So the fact of the matter is, it's going to be very difficult for the TNX or treasuries to get below the recent low. More than likely, there's a chance they get bottled up in here, maybe even begin to reverse. And I've got some lines drawn here at the 38.2% retracement. That's right about 4.25%. It makes sense if yields start to back up to that point. And again, it's a crowded trade. People take profits and await the Fed's next move. And so right now, we're not going to have treasury yields falling as wind at our back for stuff like utilities or especially real estate. Real estate's is the worst performer today. Again, despite the fact what? Yields are down today, right? There's a perception of risk right now to the market. And the fact is, there's been a lot of easy money made in real estate by virtue of treasury yields falling. All right, so this brings us to these trades to kind of kick off. What we can see by rotation, right? Rotation is going towards value-oriented names. In terms of sectors, there's one area of value remaining, and that is energy. Energy stocks are still trading relatively low multiples. However, the outlook for energy is not great. Just kind of looking out beyond maybe a year or two from now, right? But for right now, certainly oil prices may be poised to rise. Another area of value, if we're looking at emerging markets and would benefit by a falling dollar, I'm going to use FXI, but really what we're talking about here are Chinese stocks. Chinese stocks are down a lot, even relative to their emerging market peers. If the dollar starts to slide, guess what? Chinese stocks should rise. Now, the fact is that if the S&P really were to sell off, well, the dollar generally is a place where money goes. The dollar would typically strengthen. But again, we're playing this not knowing what's going to happen. And so if we're looking at rotation towards value, certainly there's defensive, like utilities. Utilities might need the wind at its back in terms of lower treasury yields. But the fact of the matter is, we're looking at the potential for utilities to slide with the broader market in the face of higher energy prices, for example. So this goes to the next point here. We're talking about what? Dollar weakness. And again, there's risk to this idea, but gold in this case should perform relatively well. It also should have an impact on oil, right? So gold and oil in this context should do relatively well. Now, gold sold today. Why? The dollar strengthened. The risk is if the market really starts to sell off, the demand for dollars usually picks up. But gold will outperform the S&P generally during a correction. Oil, again, we've still got the geopolitical side of it. The fact oil's come down quite a bit that might hold oil prices up even if the broader market's selling off. And the final piece here is what? We're actually looking for weakness, right? We're looking for real selling in the market. What can we look at? Consumer-oriented stocks. We could look at technology, for example. Technology's certainly been one of the worst performers over the last week. We could also look at travel. Now, a lot of travel stocks have benefited by rotation into high beta names. Take, for example, CCL. CCL's taken on the nose the last 2 days as we're rotating away from high beta names and travel-oriented names. If we start to see oil prices rise, which we're firming up in today's session, oil up 3.65%, again, this should create a bit of a quandary for travel companies specifically to do well or perform well in a flagging growth outlook with higher oil prices and, again, possibly a weaker dollar. But the fact is that we're seeing more of a defensive rotation away from cyclical names. So where does that put us? Well, puts us maybe potentially with bearish on something like jets. Airline stocks are getting hammered. This is a trade I walked through yesterday. Again, and we're going to be walking through these trades tomorrow during my session. These 3 areas that we're going to outline here in just a minute. But yesterday we talked about taking a bearish trade in jets based on unusual option activity. And that option activity has continued even into today's session for jets. In this case, it's a March expiration out here. We'll look at March and buying the 18 puts here, mostly bought, again, greater than the open interest. Point being is we're looking for additional downside. 18 now becomes kind of a gamma level. If we start to break through it, it's an ETF, so the gamma is going to be a little bit limited, but the downside is there in jets. Now, some people might look at this and say, well, you're shorting into a hole if you go bearish on jets here, one of our themes or starter jump starts for 2024. However, this is something we have to consider right now, right? That the market itself is in a position, right, where we expect to see more downside activity. Jets, a lot of these airline stocks benefited by the short squeeze that went on for a little while, like Delta, for example, American Airlines, United Airlines, and we saw the breakout yesterday. We're continuing down today. Now, how do you short in a hole like this? This is where we can use skew to our favor and give ourselves a little bit of time, because this may kind of bounce back here. You can wait for the bounce back, but if you did that yesterday, you missed out on today's move. So the downside in jets, I'm expecting is probably to get back down here, the 15-16 region, as we retest our lows in the next couple of months. Now, you don't have to be that aggressive, but the fact we have rising volatility here, you can construct a relatively cheap spread, buying the 18, selling the 16. It might cost you about 55, 56 cents on a $2 wide spread, which means what? You're risking maybe 56 cents if things reverse and go to the upside. Great. But you got to the downside. If we get pushed lower towards 16, your break even is going to occur around 17 and a half. And all of this down here is gravy. It's a low risk, high reward trade in jets based upon what? A continuation of weakness. Now, you could look at IYR, real estate, right? The idea is this has benefited tremendously by rising Treasury bond prices and falling yields. We're seeing kind of this topping action here with support at about 89.5. And for IYR, again, bearish trade in IYR today to the downside, buying the 88s, selling the 82s, stretching it $1.36. You collect 40 here. You're buying at 19% vol. You're selling at 23% vol. This is something at TheoTRADE. If you do not understand skew, you should not be trading vertical spreads. This is one of a very significant focus in all of our strategies at TheoTRADE. And this is one that might cost you a little under 90 cents, but you've got a $6 spread. $82 has you right here, just below the 50% retracement. And again, you might give yourself out 44 days here. Something that you could align similar to this trade. You could go to a higher strike price. There's lots of possibilities in using the skew and customizing where you want to place your spread. Because the skew is with you, it allows you to really be flexible in how you set this up. But that's a trace put on IYR. So those are a couple of bearish ideas. Expecting what? Expecting the yields are not going to continue down. Expecting stuff that's overbought is going to reverse. And some of the more cyclical parts of the market should sell off even further. Now let's look at the positive side. We're looking at energy and Chinese stocks here. So when we think about energy, XLE, again, XLE is an energy index. Sorry, it's an index ETF. We're looking at breaking through our highs today. The top holding within this is Exxon, for example. There are other stocks like CVE, for example, that had bullish option activity. But again, you can look at XLE. Now, XLE breaking out, where do we expect it to go? Well, the range is from 80.60 to 86, meaning what? There's about a $6 range. You break 86. We're looking at 92, which gets you back to prior highs. So again, we're not looking for energy to go infinitely higher here. We're just looking for a decent move as energy prices remain high and the market scrambles to find value-oriented areas of the market. Things like price to book, price to sales, forward PE, EV to EBITDA. One of the best places for all of those metrics is in the energy sector specifically. And we're seeing a breakout here. So we look at energy, XLE. We can look at vol skew. Again, is volatility rising as you move out of the money? It's not. Okay, but it is pretty level out here, right? Meaning it's not dropping a lot. You could look at individual stocks. You could shorten your time frame. If we look at Exxon as a play here, again, $5 spreads, we could go to a 9 Feb expiration. And again, you can see it flattens out here. However, in this, we got $5 spreads out here. Again, volatility is relatively stable. A 105, 115 costs you $3. You pick up 50 cents out there. 105 is right about right there. 115 is towards that 61% retracement. If XLE is going back to prior highs, Exxon is also likely going back to its prior highs, Exxon being the top holding. Again, if this spread costs you about $2.50, your break even's 107.50. And again, you've got close to 44 days for it to get above here, and everything from there on to 115 is gravy, right? It's profits on top of the move you've already seen or will see here. So Exxon's a possibility. Again, even something if you want to go towards other energy stocks like a CVE, for example. Again, you notice here for 44 days out, volatility is stable, right? So you could buy here, sell there. That's a $20 strike price. $20 is up here. You could keep it at 17 and buy an 18. It's a $1 spread. It only costs you what? It costs you about 40 cents on a 1-point spread, or you can stretch it out there as a lower probability trade, buying the 18, selling the 19. Now, liquidity is not here as strongly, but today in CVE, you'll see the activity right here at the 17 strike, mostly bought at the 17 strike, looking for upside in CVE. We're at kind of that gamma squeeze level we may push. So there's lots of areas within energy that you could look. Those are a couple of ideas here. Finally, we're going to talk about, Chinese stocks as well. China has remained subdued. Its economy is not doing well. They've tried to weaken their currency. If the dollar weakens and we see a rotation in value, that combination could create some significant upside movement in FXI, KWEB, ASHR. These are a litany of different Chinese ETFs, ASHR, KWEB, etc. A couple weeks ago, or so a little over a week ago, we saw bullish option activity across the spectrum. But FXI happens to be the one that we see the most activity most consistently in. And you notice what's going on here, right? We have a low, a high, a lower low, a lower high, and it looks like today we're putting in a higher low on FXI. Today's trade in FXI is for 26 Jan, right? This is an unusual option activity trade for 26 Jan. Out here, we're looking at the 2450. They're buying the 2450 and selling the 2650. Notice the vol. They're buying 29%. They're selling 32%. Okay? So again, what does this mean? We're looking at upside here. 2650 gets you back to prior highs. The vol skew is favorable. You're buying the lower vol, selling the higher vol. 23 days out. How about 44 days out? It's not quite as strong, but it's a similar dynamic at 25 and 27. Now, this does stretch you just a little bit higher here, buying the 25 strike. But again, you could move down to the 24 at 29.6, and you could sell the 26 strike at 29.9. So not as much of an edge here, but you have extra days. So it's not as impaired. It's not impaired. It's pretty fairly priced given the expectations. And again, you risk about what? 55 cents in lieu of about, again, of about $1.45 of upside north of 27 or 26. So the idea is we have a couple different ideas playing this undervalued and potentially weak dollar play. The ultimate in weak dollar play is gold. The seasonal trade for gold that usually begins in the fall and extends into the early new year is one that is probably not off yet. Today's trade, if we look at unusual option activity, Barrick Gold for this week experienced some bearish option activity, buying puts at the 17 strike. Well, we hit $17 today, right? We look at Newmont. These are the two largest gold miners out there. For Newmont, it's actually stretched more into the future. So we have near-term weakness, but if we look at the February expiration here, calls being bought at the 42.50 strike. So what do we have here? Short-term weakness, intermediate-term strength. And for Newmont, again, the target price based on that trade today, 42.50, it's going back to prior high. We may see this rally further. Again, if the dollar weakens, right, we may see further upside here going into the middle or end of January. So off of today's sell-off, if you didn't catch this rally or that one, I talked about option activity, and we did some trades in the area for gold stocks over all of these rallies. And with all but one right here, it fared very well. So the fact we're seeing bullish option activity enter back into the gold space off of today's selling suggests this isn't a bad time to start to consider gold. And again, you don't have to go Newmont. You could take GDX, or you could go straight with the commodity. Gold itself generally outperforms gold stocks in periods of market weakness. So off of today's spinning top, we're looking for a rally and probably a retest of the prior high at about 193. And maybe we shoot even further. But again, given what's going on with the market here, certainly a retest would be reasonable for an outlook for a gold trade. So if we look out here for February, 44 days out, gives you some time for this to play out in your favor. And notice the vol structure, it's favorable. You can buy the low vol, sell the high vol. Buy the 190, sell the 192. Deep and wide, 1 month, 2 strike vertical. Cost you 86 cents on a $2 wide spread. If you want to move it up a strike to 191, 193, that also would be reasonable. That dovetails with our expectation of a retest of the prior high. If we can get here, or probably a little bit through that point, you could probably pretty easily get out of this type of spread at a 70% gain plus if we were to push through 193 up here. 191, 193. Again, this provides an opportunity to take the same trade with a little bit lower cost, slightly lower probability. In this case, the debit drops just a little bit, Again, if we could push 293 or through it a little bit, you could probably pretty readily get out of this for a 70+% gain within a few days if we start to move quickly. So those are our three trades three trades to start the new year based upon three factors, right? Valuation, it's based on a weak dollar, and it's based on reversal in cyclical parts of the market, stuff that performed well because of the short squeeze, expecting to see high beta, high short interest stocks, likely to see more weakness. You can see like a high beta ETF we look at a lot in this video. SPHB. Expect to see a further downside here. Actually, I went to NV. Expect to see further downside in some of the high beta parts of the market. Anyway, folks, that's our trade for today. And join me in tomorrow's session as we talk more in respect to this and dig in probably a bit more in the value territory, looking at stocks that are trading at a discount right now that may be setting up well for the 2024 calendar year. Anyway, catch you back tomorrow. Thank you.